Welcome back to course number 4, Understanding Credit and Debt. In today's lecture, we're going to talk about one of the biggest traps in personal finance, high-interest debt. By the end of this session, you'll understand what high-interest debt is, why it's so dangerous, and how to avoid or escape it. High-interest debt refers to money borrowed at very high rates, usually through credit cards, payday loans, or certain personal loans. Interest rates on credit cards can range from 18% to over 25%, while payday loans may exceed 300% annually. This means the cost of borrowing can quickly outweigh the benefit of having access to money. The danger of high-interest debt is that it grows faster than most people can repay. When you carry a balance, interest is added to your debt each month. If you make only minimum payments, the balance hardly decreases, and you end up paying far more than you borrowed. What started as a small purchase or emergency loan can spiral into years of repayment. Let's imagine you borrow $1,000 on a credit card with a 25% interest rate and only pay the minimum. Over time, you could end up paying nearly double the original amount before the debt is cleared. In payday loans, the situation is even worse. Many borrowers roll over their loans, paying fees again and again, which creates a cycle of debt that is very hard to escape. High-interest debt doesn't just cost money, it affects your financial health. It can lower your credit score, making it harder to rent an apartment, qualify for loans, or even get certain jobs. It creates stress, limits your ability to save, and reduces your flexibility in emergencies. The longer you carry it, the fewer opportunities you have to use your money productively. Carrying high-interest debt also has psychological effects. Constant stress about money can lead to anxiety, poor sleep, or even strained relationships. Students in particular may feel trapped, using one form of debt to pay off another. This cycle can distract you from your studies and long-term goals, keeping you focused on survival instead of growth. Avoiding high-interest debt starts with awareness. Always read the terms before borrowing and be cautious of offers that seem too easy or too quick. Build an emergency fund to reduce the need for payday loans. If you must use a credit card, pay your balance in full whenever possible. Focus on budgeting, tracking expenses, and borrowing only what you can repay. Prevention is always cheaper than paying years of unnecessary interest. If you already have high-interest debt, there are strategies to reduce it. The avalanche method focuses on paying off the highest interest debt first, saving the most money long-term. The snowball method focuses on paying off smaller debts first for motivation. Consolidation loans with lower interest rates can also help, but only if you commit to repayment and avoid adding new debt. To wrap up, high-interest debt is one of the costliest financial mistakes students can make. It grows quickly, limits opportunities, and causes stress that impacts every area of life. By avoiding high-interest borrowing and using smart repayment strategies, you can stay in control of your finances and build a secure financial future. This concludes our course number 4, Understanding Credit and Debt. See you at the next course.